Good evening to all of you. Good evening to all of you. Welcome you to today's webinar. Today we are going to look at the mutual fund performances for investment. Now, we have had some discussion on this before, a couple of months back, mutual fund investment. So we are trying to expand that discussion now. Now, many of you may be already aware of investment in mutual funds, because the first step that investor has to take is to look at mutual funds. Then only they should go into stocks, then only they should go into derivatives. That is the step-by-step approach that one has to do. Now, the mutual fund is broadly can be categorized into different asset classes. It is there, and the various asset classes in which they are placed includes now equity. It is in debt. Okay. It is in gold. Okay. So these are broad categories of investment that is possible through mutual fund units. So you as an investor has to decide about what exactly that you want as far as a return investment is concerned. Now this could be used both for trading as well, but mostly mutual funds are considered more for some long-term investments. Now, equity, debt and gold. Now we will first look at, let us say, a conservative investor. Now when you mean conservative investor, I'm just looking at somebody who would normally invest in bank FDs. Okay, let us say you are looking at you are now getting a return in bank FD somewhere around 5%, right? So 5%, in some banks you may be getting around 6%. So this is the general trend right now in FDs. So sometime previously, a year or back, it was 6 to 7% range was there. So the first step that you normally would like to do is, can I get a safe return? The conservative investor will be first looking at whether I can get a safe return, but I should get a steady return. That is, I should get a steady return and a safe return. Okay. Then it should have low to moderate risk. That is, it should not have much of a risk. Okay. So this is the classification of a very conservative investor. With a very low to moderate risk, it should be safe, it should be a steady return. It could be in the form of dividend every fortnight, monthly, regular dividends, yearly dividends, or a growth type of mutual fund. So you want a return which is slightly above the FD, which is slightly better than the FD, but should not have much of a risk. Okay. So in those particular cases, you look at what probably could be a debt fund. A debt fund is the first type of category of investment for a conservative investor who is looking at some return which is better than the FD. So normally what we will ask is, okay, 5 to 6% is what I'm getting in bank. Can I get something like 8%? 8% per annum. So this is the first step that normally everybody puts, that if I can get 8%, I'm happy with a very steady return, but I don't want to take risk, or the risk should be too moderate, too low. It should be it must be as good as FD. Okay, if when you say there's some lot of low risk, maybe some sort of a fluctuation in unit prices on a daily basis or on a fortnightly basis, but over a period of time you should get a decent return which is around 7 to 8% or slightly better than FD. Okay. So in this particular cases, you go for debt fund, and in debt fund itself you will have many categories. In debt fund itself you will have a very different category. One is you have gilt, which is the Government of India securities. It's only purely in GSEC. It is purely in GSEC alone, gilt. Then purely in corporate bonds, corporate fund, corporate debt. There will be funds mainly on corporate debt. That can be something like credit risk fund. When you say credit risk, normally when you do an FD, what you do is that you look at the type of AAA rating, AA rating, you look at like this. So the credit risk will try to balance probably between return and the risk. So they may go for some category which could be below the AAA, maybe just AA or A plus or something like that in order to enhance the return. So this is the gilt corporate debt. Then you have a credit risk. Then you have got a mix of investment which is in, it could be in GSEC, something could be in top government owned PSUs, like it could be LIC, it could be SBI bonds, like that. So a mix which could be GSEC plus the government owned PSUs plus some sort of a top private sector corporate bonds, which could be like say L&T, Reliance, Hdfc bonds, like that. So this is another factor. So a debt will have a gilt, a corporate debt fund, a credit risk fund, a mix. So in this the corporate debt fund and credit risk are slightly higher risk categories in a debt fund. Corporate debt and credit risk or funds are basically higher risk funds. So the return can be slightly more. Okay, it could even edge towards 10% plus also. You can get in good times. So, but it has some risk. So, but you are a very conservative investor. So you would not like, first of all, any default to happen. So it should be completely safe, which means it is a gilt, right? Where Government of India securities, you have no risk as far as the credit risk is concerned. But there can be some price fluctuations here and there that take place. But over a period of time, you will have some return. You will definitely have a return. But that return, whether it's going to be 6.5, 7.5, or 8.5, or 9.5, that will depend on how the interest rate moves. So for doing a short period of time or a long period of time. So normally the gilt, normally investments are generally done when interest rates are sliding. Okay, so that means when interest rates are sliding, you get a higher return in gilts, in GSEC type of units. Now the other one is the mix. That is some amount of, maybe it will have say 25 to 40% of GSEC, then of GSEC, then you will have 50 to 60% of top PSU bonds or private sector bonds of very high rating of AAA type of category. So here the risk is going to be very low risk category, but a very moderate return. You may get something like 8%. So probably let us say you are an investor who is looking for a very safe, steady return. You will have to look at the option of either going for a gilt at an appropriate time, or you go for a mix, which is the GSEC, which has the government plus some government owned PSUs. So in this also, what you should do is that you should look at what is the duration of the fund. They will have something like ultra short term fund, say ultra short term debt. So here then you will have liquid funds. You will have liquid funds. So these will be quite poor returns. Probably this will be something like FD returns. Slightly FD returns. Sometimes it can be slightly more or even lower. So this will not exactly be appealing, because then in that case you can look at some FDs in banks which gives 6%. So the ultra short term and liquid funds may not be that attractive. So what it then goes, the next is the short term debt fund. Short term fund is there. Long term debt fund is there. So what is the difference between the short term and the long term debt funds? So in the case of a short term, what you have is what we call in these things is the duration of the time, duration of the holdings. So each mutual fund scheme will have some holdings. And holdings means the GSEC, Government of India security paper maturing 5 years, Government of India security papers maturing in 10 years, Government of India security papers maturing in 1 year or 2 years. Similarly, they will have corporate bonds issued by LICs, SBI, Hdfc and all. Similarly, maybe probably of L&T, Reliance, all those. So of different maturities, right? So what is there is a formula to calculate what is the average duration of that particular investment. So the maturity of the holdings, because when it is maturity, let us say you put in FD. So you know very well clearly that FDs, it will mature either in 6 months, 1 year, 2 years, 3 years. So similarly, the investment in the debt papers by the mutual fund units will have some maturity period. So if the maturity period is shorter period maturity, let us say it is 2 years or 3 years, okay, then in that case you go for a short term debt fund. If the maturity period is less than 2 to 3 years, then you go for a short term debt fund. If the maturity period is more than 3 years, say 4 to 6 years and all, then it becomes a long term debt fund. So the short term debt fund, so you suppose if you are an investor, so you have to decide. As an investor, you always have to decide your objective. One objective that you have defined very clearly is that I need a return which is something like 8% or so. It should be a steady and safe return. It should not have much of a risk exposure to credit Then third thing is that I don't mind holding it for 1 year or above, provided I get a very regular dividends, or probably on in a growth cumulative scheme. If that be the case, then the first preference will go to short-term fund. But suppose if you feel that I don't mind taking price risk a little bit, that is ups and downs, I don't mind, but I need a higher return, which is slightly more than even short-term fund, then in that case you have to go for a long-term debt fund. So you have to segregate yourself whether what is your investment time horizon objective. If it is going to be just 1 year, 2 years, 3 years period, 1 year to 2 years period and all, you should go for a short-term debt fund. If your holding horizon is more than say 3 years, then in that case you should look at long-term debt fund. So it's the short-term debt fund and long-term debt fund, when do you put? Now let us say you want to even invest in equity markets, but right now let us say you feel the market is slightly quite high. Whether you will get a return which is more than 8% per annum from this place, let us say you may feel a little bit uncertain about it. So in that case, and also you are looking for some sort of a correction to come in the market before you go for an investment. So in that particular case, let us say you park your funds in either FDs, which you can take it off easily through some sweep-in account or something like that. Some banks are also offering such type of schemes. Or you go for liquid funds, ultra short-term or short-term funds. So you keep, let us say the markets don't even correct for next 3-4 months. So it either remains high or consolidates at the high levels. You are waiting for some correction which could be say 10% from the top. So you may get it at some stage. So till that time you do not want to keep the fund idle. So in that case you just put it in the short-term fund, and whenever you see a correction in the market, let us say in the equity market you see a correction of 10%, you switch to something of a equity fund which can give a higher return, which can give a quite a high return. So the short-term debt fund and long-term debt fund, according to your own wish, this one, according to your taste, according to your risk preference, you can consider investment as far as short-term and long-term. Now in this itself there are different ways of investment. One, of course, you have one-time investment is possible, and then you have an SIP scheme. But I don't, unlike equity markets, SIPs will not make much of a difference as far as debt market is concerned. But in equity markets the return can be much more different. So in the case of debt market, a one-time investment or SIP should not make much of a difference. Okay. So this is one fund. This is one thing which you have to look at. So there, most of the, now once you have decided that you want to be in short-term and long-term funds, debt funds, then you look at the mutual fund, which mutual fund is performing well over that particular investment objective time period which you have. Let us say 1 year, 3 years, 5 years. In doing those period, that particular mutual fund which you are selecting, say it could be Aditya Birla fund, it could be L&T, it could be Hdfc, a short-term fund, so ICICI. So every mutual fund has the schemes in the debt funds. You look at that performance in that particular category wise. What is the performance of that particular AMC in that this one? So you just choose something which is within the first 5 in that particular period. Let us say 1 year, 2 years, 3 years, 5 years. In this, what is the rank of this mutual fund? Say let us say HDFC short-term fund. In 1 year period, maybe it is in the 5th rank. In 2 years period, it is in 3rd rank. In 3 years period, it is 4. In 5 years period, it is number 2. So you then decide that you are looking at number 1, and within 5 if it is there, I don't mind, okay, let me invest in HDFC short-term fund. So for understanding purpose, you should always look at the portfolio holdings of that any particular fund. If you are looking at HDFC short-term fund, that fund, just go into what are the holdings. So mostly you see, if you see Government of India securities, then papers which consist of LIC, SBI, HDFC, so you feel safe. That is, credit risk is not much, and there can be some price fluctuations here and there, but overall you will get a good return. So you know, and probably you know that very well, it could be definitely better than FD over a period of time. So I don't mind investment. If I get 7-8%, I think I'm very happy for a period of 1 year. Then in that case you should consider something like a short-term debt fund. Of course, due to interest rate movements, during period of interest rate movements, there can always be some fluctuations. But if you see in the next 1 year or so, I think the market interest rates will be more or less steady. I think there won't be any increase in interest rate. I don't think there will be any decrease in interest rates. So more or less we expect a very steady interest rate scenario. So in that particular case, the chance of loss in the case of this particular fund over a period of 1 year is going to be practically nil. So you may get some definitely a better return. What return finally you get will depend on the interest rate movement path. That for sure. But the risk is quite low. So now how do you look at all these things? So then in that case, you Google yourself to find out which mutual fund you should invest and how do you make an investigation in the debt mutual fund. In that particular case, you just look at, say, moneycontrol.com gives you a good oversight of all the mutual fund unit performance. So let us visit moneycontrol.com to see how the type of mutual funds that in this we have. Okay, now debt short term. See, now I will read it out for you. See, in the we can put mutual funds screener. We can put, or say in moneycontrol.com you can put top mutual fund screener. Let us say mutual funds is there, and performance tracker, top ranked funds, ETFs, mutual fund screener, top performing categories and all. So we are now looking at the mutual fund screener. Now let us say mutual fund tracker. We'll go to the mutual fund tracker for understanding purposes. So here you can see the debt funds. Here hybrid, equity, hybrid. Now we move this here. Okay. So here you have equity. Okay. Then hybrid, debt, solution oriented, others. So we'll just look at debt for the time being. Now, in the case of debt, as I told you, I'll read it out for you because of the white background. You've got long duration fund, low duration fund, corporate bond fund, money market fund, short duration fund, credit risk fund, medium duration fund, gilt fund, ultra short duration, liquid fund, banking, PSU fund, gilt fund with 10-year constant duration, all those things. So let us look at the performance that we have. Let us say short duration fund. We will just look at the short duration fund. Now, the short duration fund, very clearly they are explaining, these mutual funds select bonds debt for investments as an average maturity period for portfolios between 1 to 3 years. Shorter duration fund may provide lower returns but are lesser risky. So that is what a conservative investor wants. And for those investors who want to invest for 1 to 3 years and are looking for alternative to bank deposits. So that's what our first aim is, because we are going to go step by step. The first thing is we are looking for a replacement towards FD. And now let us say in this funds, let us look at, as I told you, okay. Now rank wise, you have for various periods of time. I told you that what are these, how the performances of these funds. So let us say our investment period is for 1 to 3 years is what we are looking. So 1 year, if you look at L&T short-term bud fund, 7.53%, Sundaram short-term bud 7.4%. So everybody is in that 7.3, 7.4 funds. If you look at all these funds, it is only in the 7.3, 7.4 fund. So Hdfc short-term fund probably has done slightly better short duration fund. If you look at it, it has done 8.58%, right? The short-term duration fund, Hdfc short-term duration fund, has done 8.58%. 8.58%. Over a period of 2 years, 9.58. Over a period of 3 years, 8.81. Over a period of 5 years, 8.43. So very clearly that over a period of say 2-3 years, the returns are flat as far as short-term debt funds are concerned. More or less everybody is in that 8% category. So this is a good fund. Suppose now you have decided that you want to invest in a short-term fund. Okay. So let us look at the rank within category. So you will have a better understanding of which fund you have to invest. So this gives a category, 1 year what category it is. So let us say this fund, which is number 2, ICICI Prudential Short-Term Fund. I think if you look at it, over a period of say 1 year, it is second rank out of 26 funds. Over a period of 2 years, it is second rank. Out of 3 years also, it is third rank. Out of 5 years, it is 1. So very clearly, ICICI Prudential Short-Term Fund seems to be doing well. ICICI short-term fund is doing well. Then let's look at some other funds which have done well. I think suppose no, you want to look at a particular fund, you can type that. Now search, let us say HDFC short-term fund. HDFC HDFC short-term debt fund. So in HDFC short-term debt fund also you can see 1 year the performance is third rank within the category. 1 year, 2 years first, third year first, fifth year first. So either you can go for HDFC short-term or ICICI short-term. So all these things have given a return. We have just seen between 8.5 to 9.5%. So 8.5%. So a very clear alternative to FD. So and now through in this we are putting a screener. In the screener we are looking at which mutual fund in what category of rank they are. Then you decide that particular fund. So you have chosen a debt scheme. In the debt scheme you are looking at either short term or long term. And if you have decided to go for a short term, which mutual fund you should invest, we are looking at the rank of those particular mutual funds over the time horizon of which we want to invest. It could be 1 year, 2 year, 3 year, 5 year, and then you choose that particular fund. Here SIP or one-time investment will not make a difference. Let us say you're done a one-time fund, one-time return, so you're getting a good decent return. So this is as far as rank within the short-term fund is concerned. So let us look at what is the gilt fund return. So gilt fund, if you look at the let us say returns on an average performance, we look at the monthly quarter. Okay, historic return. So this is gilt fund returns. So here if you see over a period of 1, 2, 3, 5 years, I think no, some of them have done at 10%, 12%, 11%, 10.24%. And so DSP Government Securities Fund has done very well with the investment which is getting almost, no, if you look at the return, this return is almost second and third year return is almost coming very closer to the equity markets. Just look at, of course, one day, I'm not exactly saying that it is near that, but look at some of the funds, they have done quite well as far as the return is concerned, and DSP Government Securities Fund has done extremely well, extremely well. And let us look at the rank within the category for this. So which one as the predominantly, Axis Gilt Fund is also has done well. And Kotak Gilt also, if you look at it, most of them are in the rank category, which is say second, third, fifth. In 3 years time period, it has done extremely well. And I think they have missed the DSP Government Security Fund. So in this particular fund, you got 3, 2, 2, 2. I think in the only the 5 year category, they have done slightly worse, 7 out of 22. Okay, so we can just choose either Axis Fund, Axis Gilt, or probably we can choose Kotak, which has also done quite reasonably well, and also DSP this fund. So let us look at Axis Gilt Fund. What is the return Axis Gilt Fund has given? Axis Gilt Fund, if you look at it, 1 year return is 10.52%. And 2 years is 12.09 and 3 years is 10.05, 5 years is 8.77. So a very, very decent return in the debt market. That is a very good replacement for the government, because even if you look at FD return, definitely you are not going to get 8.77% over a period of 5 years. So it's very clear that probably in a longer period of time, I think the gilt funds are returning something like 8% plus. If you are getting 8% plus somewhere else in the debt scheme, particularly in a secured Government of India security fund, I don't think so. So I think it's a very good return type of fund, Axis Gilt Fund or DSP Gilt. So Gilt Fund also has done extremely well. So let's look at the longer duration fund. So let us look at long duration. So that's how you select. So the longer duration fund, historic returns. So let's look at the medium to long duration fund we'll put. Okay. So the medium to long term, most of the stocks in 1 year time frame has given something like same 8. If you look at it, most of them are in that 8% category. If you look at Kotak bond, regular plan growth, which is one of those decent well, it's doing it 8.55% for 1 year. Over a period of 2 years, 10.52, 3 years, 8.92, 5 years is 8.33. So more or less, whether a medium term, short term fund or gilt, I think it all settles over a period of 5 years. It looks as if, because 5 years we have seen some interest rate cycle, and we have seen this particular scheme doing something like 8.3, and 10 years period also is done 8.32%. So a 10-year return as far as the gilt is concerned also is given 8.32%, only a shade lower than the equity markets might have given 11% over a period of time. So you are getting 8.32%, not a bad return, not at all a bad return, right? So for a debt investor, for a person who is looking at a replacement towards FD, you are now getting a 5% FD or 6%. So compared to that, you are definitely poised to get 2% more. 2% more you are poised to get. So one alternative, 2% or even 3%, because in some banks right now, like top banks have reduced interest rate to even 5%. So compared to that, you are getting 8%. So a very, very attractive thing. So what you can do is, if you are looking at some sort of return which is around 10%, then in that case, and you want to be very, very safe, then you invest something like 80% in gilt or long-term fund, duration fund, and 20% in equity. In that case also, so 20% equity return will get you, let us say, at some stage it gets you 15% return or 13% return. So let us say you're getting 20%, you're investing on 13% return. At some stage you're getting like that. 80% you're getting at 8%. So what will happen? This is 6.4 and this is 2.6. So you'll get something like 9, right? 9%. So, or if you want to go change the matrix, 30-70. 30-70. So you'll get 3.9, 5.6. So you'll get 9.4 to 10%. So somewhere around this you can plan. Maybe 30-70, 30 in gilt or medium to long duration fund. 70% in medium to long duration fund, 30% in equity fund can still get you something like 9.4 to 10%. Okay, which is almost double the FD return that you're getting. And some benefit you get in equity schemes because of the long-term capital gains tax you get, and in debt funds you get that particularly after 3 years or so. So I think more or less you will have a much better investment thing. So the first step that anybody who takes into investment, I think into mutual fund investment, and who are looking for a replacement to the FD should consider debt fund. And in debt fund, you should analyze your investment objective period, that is investment horizon period, and then you should look at what return, probably schemes which can give 8% return consistently over a period of time. You can even take a dividend, a fortnightly dividend scheme or regular dividend scheme, or you can opt for a growth option. Then in that case, after that, you look at the rank within the category. You can go to moneycontrol.com and select which mutual fund has been doing consistently well over a period of 1, 2, 3, 5 years. And we have seen in most of the schemes, we have seen Hdfc doing well, ICICI doing well, Kotak doing well, DSP doing well. So in that case, you can go for investment. In the case of equity schemes, you will advocate for an SIP scheme because you would like to take advantage of a falling market at some stage. But whereas in this particular case, in debt market, there is not much of a necessity for an SIP scheme. If at all there is some change, okay, you can invest more. But otherwise, generally, one-time investment itself can give you a very good return as far as the debt mutual fund is concerned. And other thing is that in the case of debt mutual fund, it can be bought in your brokerage platform itself, right? You have a screen, and you have a facility to invest in mutual fund units also. So if you do the mutual fund units, then the investment is locked into your demat account. and you can sell that as you wish. So you get a fantastic way of execution without a problem. And most of the schemes today have no exit. Most of the schemes don't have an exit load. One. And second thing is you can make a switch whenever. Now, let us say you invested 10 lakhs in debt scheme in one of this. Suddenly you see the equity market like this particular last year in March or April correcting lower. Then in that case you go for a switch from the debt scheme to the equity scheme, or a part of it. Part of it is switch from debt to equity at an appropriate time. Till the time you can be invested in the debt fund. Second thing is that the market may not crash, but there can be correction. Like even last month before the budget, there was a 1,000 points correction. But normally when you see a fall which happens to be 5% or 10%, then from that particular place you get a very decent return over a period of time. So there in that case you also go at the switch to equity funds. So that is one thing you can do. Second thing is, let us say you would want to do a systematic investment plan in equity fund. We will come into equity funds a little, even if time doesn't permit to complete our discussion today on equity funds, because the time is short, because we want to explain a lot on the mutual funds and how beneficial it can be. See, in the case of equity mutual funds, you would like to go for an SIP. So when you want to go for an SIP in the case of equity mutual funds, let us say every month you have to put some money. So let us say today you park everything in a debt fund, okay, which could be short term or ultra short term or medium term fund or gilt fund. So you keep getting the returns. Then at every month, or so, whether the market rises or whether the market falls, you can take some what we call as a systematic transfer plan. So you transfer that money either from your FD or from your debt fund into equity markets. So you can do a systematic transfer plan from one scheme to another scheme, from a debt scheme to equity scheme every month. Till that time you can continue to get your return in the debt scheme. Okay, so that way you can make your plan. So you don't need to lose no interest till such time you invest in equity markets. One. Second thing is that instead of doing a time-bound systematic investment plan equity, you may look at some correction in the market before you go for an investment, right? So you invested some money. So every percentage of fall you would like to go for an investment. So in that particular case also you can decide to use the debt fund as one parking vehicle, and from there you can transfer the funds as and when you get a correction in the broad funds, which could be 5% or more. Okay, so this is as far as giving a synopsis of the fund return that you get. So for that, and also we told you that most of these schemes, in the case of gilt, there are some ETF funds. We will just look at a particular ETF fund or so. I think SBI has got one ETF fund as far as listed in the NSE itself. But instead of going for ETF fund, as far as debt market is concerned, it is better to go into mutual fund unit platform and pick your type of investment. So you can also log into a site, I think Value Research Online. They do a very good research and assign the credit risk. Value Research. You can go to the site Value Research and look at their way of assessing the debt funds, the category, the ranks they assign. And based on that, you can make your investment in debt funds are concerned. So this is where we stand as far as debt funds is concerned. Now we will switch ourselves into equity schemes, and if you want to be in equity schemes, what are the avenues that are there? So from debt fund, we are now looking at equity fund. Okay. So when you talk about equity, the first thing that you normally what should come to your mind is, okay, index. Now, can you beat the index as far as the return is concerned? So what is the return? Because most of the this one will compare themselves with the index. Okay. So whether the funds are able to beat the index is the most important parameter that we should keep in mind, because a lot of funds may still fall by the wayside and may not be able to beat the index performance. When I say index performance, let us say on a 3-year basis, if index is now returning 12% per annum, okay. Now whether this fund which I am selecting can give me something like 15% or 16%, because at least I should get some 2-3% more than the index fund. Otherwise I can just be a passive investor as far as index is concerned. So the first thing that you should normally look at it is, when you are going into an equity fund, I think let us look at the ETF, okay, exchange traded fund, or index fund. It could be exchange traded fund or it could be an index oriented fund in a normal mutual fund platform. So what does it mean? That is basically the mutual fund invest in the stocks which are there in Nifty 50. Let us say it's a Nifty fund or it could be a Sensex fund. So that means they hold those shares which are there in Nifty. When they say Nifty, probably it could be Bharti Airtel, it could be Reliance, it is Infosys, TCS, Bajaj Finance, Bajaj Auto, Hero Honda, then Hero Motors, then Maruti, M&M, then Sun Pharma, TCS, Wipro, HCL Tech. So these are stocks which are there in the Nifty 50. So and Nifty they have assigned some ratio for Hindustan Lever so much, for Hdfc Bank so much. So the index comprises of all sectors, most of the important sectors, whether it is steel, auto, bank, finance, cement, IT, pharma, auto, this one there is two-wheelers, four-wheelers, tractors. So it is quite a comprehensive sectoral this one. In that particular sector, certain sectors might have got an additional weightage. For example, banking sector has got nearly 35% weightage in the index right now. And then you have got IT sector. Then you have got some single particular stock. If you look at it, maximum weightage could be both for Hdfc and Reliance. So these two stocks may be occupying considerable portion of the index. So to whatever extent the index stock, this one, the same way the investment is made by the mutual fund units. The same composition, the percentage of composition in the index is to that same extent those shares are held by the mutual fund, So what happens is that when you do this in this ETF fund, ETF or it could be index fund. I am saying about index fund. Index fund can be categorized into two. One is of course the big category of Nifty. There will be Nifty index fund. Then you may have on bank Nifty, right? So same thing, Nifty, bank Nifty type of thing. Then it could be IT. IT is there. Then you have a pharma. Then FMCG. So all those categories are also, you have got index. That is the funds are there. That is FMCG fund, pharma fund, IT fund, bank Nifty, Nifty funds. But these are all a little sectoral. That sometimes they may outperform the index, broad index, or it can underperform. So we have seen to a very large extent till the budget time, Bank Nifty was underperforming Nifty because we saw Nifty scaling new highs much earlier. Bank Nifty was able to scale it only after the budget because of the change in structure of the way the banks are going to operate, because of the bad bank asset reconstruction company going to be done by the government of India. So the Bank Nifty, till recently it was not doing well. So there's a Bank Nifty. Then you've got IT. Now this has done spectacularly well and it has even outclassed Nifty. This has outclassed Nifty in the last 1 year. When Nifty returned 15%, this has returned even 30-35% in the last 1 year or so till December. So sometimes it may have slight underperformance, but generally IT sector has the ability to beat the Nifty index over a period of time. So this could be there, and this pharma, FMCG, auto, all these things will depend whether that particular sector is in flavor at that point of time. So you have to decide now whether I should be more into this. So probably right now the Bank Nifty is giving a much bigger rally. Possibly yes, Bank Nifty, this one, that is the investment in Bank Nifty right now, probably a fund can give good return. So you yourself become your own fund manager depending on how you see, how information that you gather. But if you want to be a very passive person, now if you are very discreet and if you are tracking the market, getting a lot of inputs, now probably at this point of time you may decide that Bank Nifty can outperform Nifty. So let me be in Bank Nifty fund for the time being. And whenever you get something negative, just get yourself out of Bank Nifty and put it in some other fund. So right now Bank Nifty will has a possibility to do well. But generally speaking, that over a period of time, since the Nifty also comprises Bank Nifty, but it comprises a lesser portion because it has to include IT in Bank Nifty also. But Bank Nifty plus IT may constitute more than 50% of the Nifty. So a Nifty also will do well in case Bank Nifty is going to do well. A little bit of underperformance can be there compared to back Nifty, but nevertheless it's okay. So the index fund is the most important thing, and index fund, if you look at it, the n number of index funds which could be which are available. So whether it is done, some of the index funds are listed in the exchange itself. So you can buy the way you can you buy a share. So right now, if you look at it, there are many index funds available. Your ICICI fund, ICICI Nifty, ICICI fund is there, which is it's an ETF which is listed there. Then B's, Nifty B's is there. Nifty B's is there. This is all exchange traded fund in the index fund which is available. I think even SBI is there. So these are all funds which are available on the broad index. Okay, Nifty B's, ICICI Nifty, all those things. Now you also got ICICI Tech, which is on the IT sector, which is purely on the IT sector. Then you got Nippon on the tech sector. So these are funds which are available, this is sectoral funds, and this is a broad fund, that is exchange traded fund. ICICI Nifty, Nifty B's, ICICI Tech, Nippon Tech. Okay, so these two are sectoral funds. This is a broad fund. Okay, so let us look at the broad performance of the index, and then we will continue our discussion again next week on this topic. So now we will look at the equity schemes. Okay. Okay, now we will put index funds. Index funds. So in others, if you go, you can put an index fund. So index funds, normally all index funds should generally do the same way. So let's look at the performance. If you see the performance, let us look at the performance, except for I think the first one, SBI, I don't know why it has not done well in the last 3 years. Everybody, if you look at it, 3-year returns, they say 15%, 15%, 14%. So most of them should be in the same category, unless there was some small change here in this principal Nifty under equal rate fund. So probably there was a slight different type of allocation, so it did not do well. But most of the other funds, which are basically Aditya Birla, Sun Life Nifty, so everybody is in the same category of 3 years. If you look at it, almost everybody is in the 14-15%. So keep in mind that over a period of 14-15 years, these are all annual returns. Over a period of 5 years, if you see, most of them are in the 18% category, right? Most of them are the 18 to 19% category over a period of 5 years. And over a period of say 1 year, everybody is in the 25% category. So over a period of 2 years, everybody is in the 17-19% category. So index funds have generally returned, right? So because of the bullish nature, they have all returned something like 15-16% over a period of 3 years, 18-19% over a period of 5 years. Then in the short period, it is slightly more also in the period of 1 year. So this is the return that right now we are getting. So exchange traded funds has given this particular return. Now keep in mind, when we benchmark ourselves, so the 3 years fund and 5 years fund, 5 years is 18, 3 years is almost 15, 1 and 2 years is 25 to 20. So our entire thing is that we should look at whether we this particular index funds can be outclassed by other type of funds, which could be a large cap, multi cap. So the next other type of funds that will come are in the equity funds. The first is that what I talked about, the ETF funds. Okay, ETF funds. Now I think the IT funds has not been shown here. I think we will look at the so there is no particular IT is coming. See, Nippon. They are all of a short not much of this one, the history is available as far as IT funds is concerned, because most of them have been launched quite recently. So the let's look at the IT funds in this. I say it's a Prudential IT ETF. Okay, we don't have any particular this one. There is no not much of information is available, because it's only last 6 months to 1 year they have mentioned. Okay, so because if you look at it, category average, so even 1 year has not been given. It's only since inception is given, and inception is only in 17th August 2020. So not much of time has gone, and so it's very difficult to evaluate this. So we will look at the whether there is any other fund which is in the case of even Nippon India, we don't have much of information as far as IT fund is concerned. Okay. Okay. Now, we have already talked about ETF funds, which is Nifty 50 stocks. Now, there are things where no SBI has put BSE 100 funds, BSE 100, but there also we don't have much of a comparison draw, which could be 3 years and 5 years. So most of the other schemes which have come, where probably they have done certain modifications, we don't have much of information. Except that sometimes the diversification has not proved to be very successful also. That's why ETF is better, because if you look at Motilal Oswal mid cap fund, I say Prudential S&P BSE for 500, that is, it has got 500, that is, it includes probably the mid cap and small cap also, but that over a period of say 3 years has not performed that well. Over a period of 5 years, for 5 years it's okay, but over a period of 3 years that has slightly fallen by the side. So there are enough number of funds here, so you can look at what probably you can look at it, whether you want index fund purely based on Nifty, or you want a junior index fund, or you want an IT fund, or you want a bank fund. So you can look at all these types of funds and then take a call regarding which type of this one that you would prefer. So now you keep in mind that that is exchange traded funds at for the Nifty is offering something like 18% over a period of 5 years and 15% over a period of 3 years. In 1 and 2 years, it is it's all ranging in the region of 20 to 25%. This we will keep it for comparison with large cap, mid cap, and small cap, and then decide what is the most appropriate thing, and we will carry forward the discussion. Because after we complete the equity fund, we will have a look at the gold fund also, and look at one broad conclusion on all the mutual fund. We will carry forward this discussion next Monday. On Friday, we have again a topic which is mostly on the same pivot point profitability thing. That is, if the open is greater than R1, R2, based on that, we will just look at the those discussions. Okay. So thank you very much. If you have any questions, you can ask now. Thank you. So hope the session is productive, and you can invest in the mutual funds through the platform that has been offered to you, and also the ETFs you can buy like the share, this one, and mutual fund units which are bought also can be put it in a demat account, and it can be bought or again sold, switch, all those things can be done. So very easy facilitation like a normal stock, you don't need to bother about it. And today most of the funds don't have exit load. We also need to look at the SIP. What is the whether SIP is better or one-time investment is better. So even in ETF, we will look at the which one is better. So thanks for your participation. Hope to see you again on Friday. Thank you very much.